Thank you for joining me for another topic in InStyle Finance, where we talk about business, finance, and real estate, and all financial matters of that nature. And then today, we're going to be talking about a topic that I wanted to get the video on, and that is the qualified retirement plans. And basically, in this article, I basically write out the mathematics behind how 401ks work. And I'm so surprised that there's not much of a highlight on this. So I just wanted to just make this a video so that way more people know. So what you're looking at is basically a quick, simple financial breakdown about how tax deferred plans work, which is like 401ks, IRAs, basically anything that's going to give you a tax break in the beginning of the contribution phase, and then you're basically going to be paying the taxes in the distributions. Now, normally it's sugar coated the way they implant these plans in your companies. Like a lot of times your HR department is the one that's going to say like, oh, we offer retirement plans. This is what they're going to be offering majority of the time. Like 90% of people, when you talk about retirement plans, they're going to think about a 401k or an IRA. So a lot of people have these plans, but they don't know how they work. And if you were to ask me what these plans mean to me, it's basically pushing cattle off a cliff, if you ask me. But I'm going to show you the math so that way you can see what I mean. So if you can see right here, I have 1, 2, 3. These are the 3 rules you got to know about running one of these plans for your retirement. First is that since these plans are set for your retirement, you can't touch them before you're 59 and a half. If you do, you get a penalty of 10%, and then on top of that, you have to pay the state and federal tax. Second thing you got to know about these plans is that there's a required withdrawal before you're 70 and a half. So basically, during this whole time, you're not paying any taxes, but Uncle Sam is waiting to make his taxes, like to make his money off your investments. Yeah, I'm going to explain what that means. So stay with me. And if you don't take those contributions out, if you think like, oh, I'm going to leave that for, my granddaughter or, for the family legacy, so put in a trust. Nah. If you don't take that money before you're 7 and a half, Uncle Sam is going to take 50% off that, okay? I'm not playing. And the third thing that you got to know is that you never know what the tax bracket is going to be when you retire. Like, for example, as I'm talking about this video, the Fed just raised the interest rate. We're just in a recession, even though they don't want to say it, but we're in 2 consecutive negative growth periods. So people who are retiring in the next 2 to 3 years, they're going to be paying extra taxes, higher taxes than the people that retired a few years back. So now that you're kind of getting an understanding of where it's going, now let me go into the math. Now, I do have, there is a book available on Amazon. It is available in there. And the reason why I'm bringing that up is because there is a lesson in there to know how much you should be saving towards your retirement. It's actually this book right here. I believe it's chapter 9, and I talked about it in another book about the mortgage, but how to budget yourself. But in this example, I'm gonna go into, in a little bit, I will go into what income you would have to be so that way $5,000 would make sense, because I understand most people, especially here in California, they're not in a position to save $500. Only a few are, and those few that are able to save $500 every month, those are the individuals that are kind of talking about leaving California. But I'm going to slow my roll here and then just let the math speak for itself. So let's say you're in a position to save $5,000. Sorry, 5,000. Where is my head going? $500 a month, right? Give that a year, that's 6,000. Now, say your tax bracket is 25%. So that basically means that since you were putting in $500 every month for that year, in participating in those plans, you get a tax break. So you wouldn't be taxed at 25% as if your income is, because later on you're going to be taxed for that amount. So you're getting a tax bracket right now, the tax break right now, because you're not paying any income on those taxes. Because mind you, every year you pay income tax. It's sneaked in there, but you're paying income tax unless you live in those nice little states like Nevada, I believe Florida, Arizona, those little hick states. Unless you're one of those, yeah, no, you're paying income tax. Okay, so and not paying the income tax for that year, you're just kind of kicking the can down the road. So say if you worked at that same company for 30 years, and say if that tax break was the same, during those 30 years you save $35,000 in income taxes in the beginning. All right, let's remember that number. $45,000 was saved in the contribution phase. But that's just the first phase. This is the second phase. The accumulation is basically how your 401k works. Now, your 401k is just basically made out of a bunch of mutual funds. What are mutual funds? Mutual funds, plain and simple, is a bunch of stocks around different sectors of the industries, and the main thing is that they're all run by an account manager or such. These management firms, they charge fees so that way you can participate in their diversification. Now, if you're deep in the game of the financial world, you know that you only diversify when you don't know what the F you are doing. Now, when you have high interest mutual funds with a bunch of people who don't know what they're investing in, yeah, Wall Street managers are making money off you whether the market's going up or down. But in this example, I'm just going to be nice and sweet and say that the market is going to give you a 10% rate of return every year for the next 30 years. Is this possible? Absolutely not. But I'm just going to paint the pretty picture just so that way you can really see what is behind the curtain when you get involved in these plans. So bear with me. If you're wondering how I got this number here, I used a financial calculator. And in my book, I actually write about how to use a financial calculator. I think I can even try to see if I can pull it up here. And if you're wondering what I like to use for building up these videos, is Canva. Although right now for the video, I am not using Canva. Oh, you know what? Okay. Yes, for this plan, I actually do have a formula about how to know how much money you need for your retirement. But here I basically show how I was able to break down to get the number that I needed to know what the growth would be here. And you can also Google a financial calculator. But anyways, I digress. The amount that money will grow down to for the next 30 years at 10% for contributing $6,000 every year, it will grow to $980,964. Okay? That's how much it grew to be. Now, mind you, you haven't paid any taxes in the contribution or in the accumulation phase. So guess what, buddy? We're paying taxes in the distribution phase. And I also gotta mention, if you're wondering why my screen looks funny, it's because I do the color inversion. If it really bugs you, you could do the color inversion setting on your computer and it would fix it. But technically, this is supposed to be easier on your eyes. And if you're someone like me that's around the computer a lot, it makes you last a little longer. So bear with me. So now just remember, for most people, their 401k is their nest egg. It's basically their only retirement plan they have when it comes down to being able to enjoy their golden years. So they got to make this money last, because back in the day, they used to have pension funds that used to do this for you. But now, since pension funds were taken out, we may have to make this money last, because once this money is done, it's done. Okay, you can outlive your money in a 401k. There is no safety net. So let's just say this person is going to be conservative and is going to live off 6% every year of that nest egg. That means that their income amount every year is going to be just under $60,000 every year. And if this was California, which I'm talking out from California, this is tough. Okay? Now, this is where I was talking about how do I say, the rainbow or the sugar coating. Is basically here I'm saying that the tax rate hasn't gone up. But like I said, the taxes have gone up recently. So who's not to say that in the next 30 years, that tax bracket of 25% is going to look like 35%. But I'm not going to go all grim here just yet. I'm just going to say the taxes stay the same. But guess what? That math ain't the same. Because check that out. If you put 25% of a tax bracket of this income right here, your taxes every year is going to be $14,715. Now, a lot of people say, oh, you're not going to be making as much, you're going to be in a lower tax bracket. That's not always the case, because a lot of times your house is paid off, so you already have some assets to your name, and you're seeing the doctor longer. So sometimes now you're getting in a position where it's like, okay, I have to make expense for medical bills. You're not in the same, you don't get the same tax credits as you used to do, because meanwhile you're working during this phase. If you have a family, you know, you get your marriage credit there, you get your children's credit there, and you get your mortgage credit there. When you're in this stage of your life, your kids are already grown. If you're lucky to still be married, congrats. But that mortgage is paid off. So now you're paying that property tax. And then for the next 30 years, if everything stays the same, when it's all said and done, you're just paying just under $500,000. Well, I'm just being super exaggerated, but here, $441,435,000 would be paid in taxes, just because you didn't want to pay $45,000 here. So you tell me, where does this make sense to pay taxes? In the front end or in the back end? Obviously the front end, people, because you're paying less in taxes. Now, if you're wondering, well, what can I do besides a 401k? Well, luckily, I wrote an article about the Roth IRA and the Roth 401k, in which it goes into a better detail of how that works, so that way you don't get stuck paying all those high taxes. Because in reality, I believe I have a video that I recommend in this blog, because I'm getting ahead of myself. Jeez. Oh, okay. I believe I have a video of how the 401ks were started. In reality, when the pensions were taken out, the 401ks were made for the executives, for the top tier making people in the company. It wasn't made for the janitor, the clerk, the secretary. None of them are in the high tax brackets. So yeah, I just basically want to leave it off that, and just so that way you guys can know more about this article. I go into more of a history in the text. I go into the history part, but I'm going to be adding this video because it's just going to be snapshotting what I want to say in this article. But if you want to know the history, read the text. It goes into it, and then I even have a video in the end. PBS. You could also find it on YouTube, but I recommend learning more about the 401k, because don't go into the flow, people. What majority of people are doing is just going with the flow and just throwing their money away. Be conscious with your money. So just want to leave it at that. Thank you for coming into the InStyle Finance, and I hope to see you in the next article or video blog. Okay? Have a wonderful day, y'all. Bye.